The filing deadline for those with a filing extension is October 15th this year. Remember, the FBAR has the same exact filing deadline, which is October 15th. So if you are a new client to MyExpatTaxes, make sure to take advantage of our promotion code here on the screen so that you can get 10% off the base price. Hi everyone, I'm Natalie. It's time for another webinar. So an update of our webinars for the year. This one is the self-employed and small businesses webinar. So basically, if you're a business owner, whether it's a small one-person business or you have a giant multi-million-dollar corporation, if you're a US citizen and you're abroad, this information will probably be relevant to you. So let's see what we have. Alrighty, of course, before we start, why am I here? Why am I telling you all of this information? Well, like I said, I'm Natalie. Maybe you know me, maybe you don't. If you don't, I am the CEO of MyExpatTaxes, and I'm just like you. I am a business owner that lives in Austria, so outside of the US. I have a company that's incorporated outside the US. And basically, when I started my journey abroad, the question was, how do I file my US taxes? So when I started my journey, I was an employee and it was still not very easy. Long story short, I created MyExpatTaxes, now the leading tax software for US expats filing their US taxes from abroad. And yeah, I hope I can give you some good information today. Okay, so again, what we'll go through is different company types because there's a lot of ways to be self-employed. What self-employment tax is, that's probably one of the biggest concerns, I would say, for those that are self-employed. And of course, if you do have an actual corporation with limited liability, what are these crazy foreign corporate forms? Why are they so expensive? What is Form 5471, 8865, blah, blah, blah. And of course, then just an overview of what's the different types of self-employment profiles that we have and kind of how that leads towards your US tax reporting requirements. And of course, just to make sure we're all on the same page, US Expat Tax 101, what are we even doing here with our US taxes? And if you haven't been filing, if you've forgotten some of these foreign corporate forms that you actually need, how do you get caught up with the least amount of fees? So, company types. There's a lot of different types of companies. You can be a freelancer, right? A self-employed person, sole proprietorship. You're just one person operating, probably under your own name. And yeah, just doing business. You can obviously have a company. So maybe you're not operating under your own name, but you don't have limited liability. You can incorporate a company and say, actually, the company is a separate entity from myself. And so if there's any legal issues, financial issues, the company is its own entity and I have limited liability from that entity. So that is, a registered company with limited liability outside the US. You could say, I'm going to join in on a partnership. So I do have liability from the partnership, but I'm joining in with a couple other folks, right? And then we will distribute the income among us based on our partnership interests. So if you have a foreign partnership, then that's also could be considered something that needs a foreign corporate form, so a little bit more complex. You could have a foreign disregarded entity. So this gets a little bit more confusing because now we're getting into really tax terms. But that basically just means if you have a limited liability corporation incorporated abroad that you decide that you do not want to file Form 5471, but you disregard it as a foreign disregarded entity, hence, unless you know what you're doing, this is probably not for you because it's a little bit more tax savvy, so to say. You could just have a company, an LLC, limited liability corporation in the US as a single member. And then that actually would also be considered disregarded automatically on Schedule C. Again, if you don't know what I'm talking about, this probably is not for you. You could have an S corporation, another type of corporation in the US that would then pass your income through on a K1 that then goes to Schedule E. Again, something, if you have no idea what I'm talking about, probably not for you. I think you're starting to get the gist that it gets a little bit more complex. And of course, the last one, which is pretty rare, but you could be a statutory employee. which basically means that you are considered an employee, but then kind of also self-employed. So you would actually claim that income on Schedule C instead, even though you're kind of like an employee. It's mostly for insurance agents in the US. So again, if you don't know what I'm talking about, probably not relevant for you. Okay, now, again, we dive into the most relevant topic that I touched on, right? Which is if you are self-employed, you need to understand, do you have limited liability or not? That's the main question. That is the main question on how to determine how to report your business income on your US tax return. So basically, there is the difference between you being a private person versus a corporation. Are you doing business as yourself? Are you taking on that full liability, like I said? So if something happens to the business, is your own personal assets at risk? If yes, then you are not operating under limited liability. If your own personal assets are not at risk, then you're most likely under some type of corporate structure that has limited liability. It can, obviously range different corporate structures depending on where you live. So Germany has different types of structures versus France, etc. But it always comes down to, do you have limited liability or not? If you have a corporation and you have limited liability as a business owner, then what that means is basically you will need to figure out how to declare your corporation income first. If it's a foreign corporation, that's on 5471 included on your normal tax return. I will get to that. And then the income then flows to your individual tax return. If you don't have a corporation, then you'll most likely just report this income directly on Schedule C. So I know it's kind of confusing. Hang with me. I just kind of threw it all out there so you know if this is relevant for you or not, but we will get into the details. Before we do though, my slide says we got to talk about self-employment tax. So again, if you are a private person, this is a little bit more relevant for you, but basically anyone that is filing Schedule C. So Schedule C is the form that says this is all of your income, expenses, and your net profit. If you are filing Schedule C, which is most common for self-employed folks, freelancers, sole proprietors, disregarded entities such as U.S. single member LLCs, then you could be subject to self-employment tax. So self-employment tax is just a fancy way to say Social Security and Medicare taxes for those that are self-employed. It's about 15.3% of your net profit. So it's a good chunk of tax, but it's not income tax. Again, it's a Social Security tax. So this does actually go towards your US Social Security benefits accounts credit. So if you're living abroad, you can actually still contribute to your Social Security benefits account, and you need about 40 credits at the end when you retire in order to receive US Social Security. So we're not Social Security experts. Please don't give us all of your questions. I'm just here to tell you that if you pay self-employment tax, that is a way to contribute to Social Security benefits in the US. And yes, you can receive US Social Security benefits, aka retirement income, living abroad. Anyways, not everyone obviously has to pay self-employment tax if you're abroad, because otherwise you would have a lot of very angry US taxpayers living abroad. Most folks actually can get exemption. So there's something called a Totalization Treaty. And a Totalization Treaty basically says if you are paying Social Security taxes on your self-employment income in your local country, you don't have to pay for it also in the US, right? You don't have to be double taxed on Social Security. You can opt into one country's system. So if you have this Totalization Treaty between you, the country you live in and you work in, and the US, then you may be eligible to use it. And if you're eligible to use it, aka you are registered as self-employed in your local country, you're paying the relevant taxes, you basically can claim the Totalization Treaty and get exempt from this 15.3% self-employment tax. It's a little bit difficult to claim the exemption just because the IRS has not made it straightforward. But basically what you normally need is a certificate of coverage. So some type of certificate saying, yes, you are registered abroad and you're paying the relevant taxes abroad. So you would normally attach this to your tax return and paper mail it. Yeah, paper mail it. Obviously, that is not practical for the thousands and thousands and thousands of people, hundreds of thousands, right? Millions of people filing. And so you can e-file without it. Just know that you need to have this certificate of coverage on hand in the very rare event that the IRS would ask for it. Anyways, if you are not exempt because you don't have the totalization treaty with the country you work in, or you're just not registered in the country that you work in, and maybe you're working for a US company from abroad, getting self-employment income and not necessarily reporting it. I'm not here to judge on your local taxes, just your US taxes. Yeah, you'll have to pay the self-employment tax, but it's not all bad because again, if you are paying self-employment tax, you're not losing this money necessarily. You can earn up to a maximum of 4 credits every single year. And once you have 40 credits, you can be eligible to get Social Security benefits later when you retire. So it's actually a pretty good system where you could get retirement income from, multiple countries. Just keep in mind, obviously, the amount you get is dependent on how much income you pay tax on, and you can only get up to 4 credits per year. But if you pay more tax, then the amount gets adjusted. Again, not Social Security benefit expert over here, just letting you know that if you pay it, it's different from an income tax. It's a Social Security tax, meaning it can help you later on. It's not all loss. So the slide you'll see is going to be a list of all the different countries with a totalization treaty. This can change at any time. Treaties can get revoked. Treaties can be added. Most treaties are generally the same, where they allow you to opt into the country you're working in, right? So if you're self-employed in Germany, you can opt into Germany's Social Security system and not pay US self-employment tax. Italy is a little different. I don't know why, but Italy basically only allows this option if you're a dual citizen, so Italian and US. So if you are in Italy and you're a US citizen and not a dual citizen there, not Italian and US citizen, just be aware that even though there's a totalization treaty, you are still expected to pay US self-employment tax and not Italian self-employment tax necessarily. Please, obviously work with your local Italian tax consultant for that one, but we can just tell you on the US side, you would not be exempt from US self-employment tax unless you were a dual citizen. Okay, so that's kind of the self-employment tax portion. So that is what people that are operating as more private individuals doing business, so again, freelancers, sole proprietors, basically that's something you have to worry about, right? Now, say you have a corporation. You incorporate a company abroad. So you have a limited liability company. You are generally not subject to self-employment tax because you are operating through your company. And then you probably are paying yourself a salary, right? Or dividends. So generally you are not dealing with self-employment tax unless, of course, you have some weird setup where you are getting self-employment income. Anyways, back to the basics. If you have a company incorporated abroad, you may be subject to filing Form 5471. A lot of information on the screen. I will just tell you the most relevant is basically the minute you know that you own a foreign corporation, you have some type of ownership in it. If you have more than 10%, be aware you may need to file Form 5471. Form 5471 is a high penalty form. If you don't file it, there is a $10,000 penalty on this form. I have not seen the penalty actually enforced on 5471, but I have seen it enforced on similar forms like 3520. So that $10,000 penalty is real, and you do not want to be on the other side of an IRS notice saying that you owe $10,000. We've seen it, they're not fun. So please, take this seriously. Anyways, if you own more than 10% and you acquire or dispose, shares in that year, you may have to file this form because basically you could be seen as, a category 2 or 3 filer. There's 5 different categories of filing. I'm probably going to give you information that will go in one ear out the other, but just stick with me. If you own over 10% and you acquire or dispose of shares, or there's other shareholding changes, you may have to file the form as what we call a transactional filer because there was a change in that year with the shareholding under category 2 or 3. If you own more than 50%, you will need to file Form 5471 always, because you have control of the company, so over 50%. You have control of the company, and because you're a US citizen and you have control of the company, so over 50%, it's considered a controlled foreign corporation, meaning you will need to file this form as either a Category 5 or 1 filer, as well as a Category 4 filer, and this is an annual filing. Every single year you have to file it. Now, here's where it gets a little bit more complex, if it wasn't already complex enough. I like this form. I've come to grow slightly attached because we've done so many of these filings, so maybe you can hear that in my voice, but I'm sure you don't like this form. Anyways, now it gets a little bit more complex because of constructive ownership. So now you're sitting there going, well, I don't own more than 50% because I did it really smart. I own 49%, and my spouse, who's not a US citizen, owns 51%. So I don't have control of the company. I don't have to file. Not true. The IRS knows this one. So there is a such thing as constructive ownership. So basically, if your spouse or a family member, so family members will normally be parents, children, people you have control over. Your siblings are not included because the IRS acknowledges you do not have control over your siblings' decisions. But if you or your spouse or family own over 50%, you are still considered having constructive ownership. So you also own over 50%, or you have control at least. So basically, the details get a little different in this case. This webinar is just not the place to get deep into the different ways that the taxation will then work based on if you or a family member then owns shares. We do have a premium masterclass in our premium plan that you can watch on demand at any time. Otherwise, we have planning services. But I'm just here to tell you that if you or your spouse or a family member that would be considered in constructive ownership, if you together own over 50%, you're still a Category 4 filer, you still got to file 5471 annually. Sorry? And the last one is just if you are a director or an officer of the foreign corporation, and there is a requirement to file this form because, say, it's majority owned by US citizens and no other US shareholder does it themselves, then you do fall on the hook to file it on behalf of them. So you probably got that it's pretty complex to even decide if you need to file this form or not. We do have questions that kind of guide you through it in MyExpatTaxes that you can access before you even pay, just to see if you need Form 5471 or not. But again, every situation is unique. If you're unsure, you should definitely get in touch with us, just because not filing this form can result in a $10,000 penalty, which we do not wish upon anyone. It sounds complex. Is it expensive? Can be, yeah. Of course, it is a little bit more expensive. I mean, you set up a company, you set up a legal entity outside of yourself. So it gets more complex. What is the true cost of this? So obviously, there's the tax preparation fees, right? So for us, if you file Form 5471 or a similar form like for foreign partnerships, which I don't touch too much on in this webinar, really not at all, just because they're not as common. But just so you know, if you have a partnership outside of the US, right, and it's basically you have more than 50% control. So again, in this situation, say you and your non-US citizen spouse have a partnership, you can expect to also need to file a foreign corporate form, which is 8865. Anyways, if you have that or a foreign corporation, you can expect you have to be in our premium tier, which is our highest tier. And then on top of that, you will have to pay 299 euros per foreign corporate form. So if you have multiple corporations, if you have multiple filing years, it does add up. We try to make it as affordable as possible, keeping in mind that if you file with other firms that do this, obviously there is no other tax software besides MyExpatTaxes that will do this in a more automated way, so to say. But if you go through any other US tax firm, you can expect at least paying about $500 to $1,000 to plus per form. So again, we try to keep it affordable just because we do have the power of our software to help us through it and to make it a faster process. Form 5471 is more complex because It's also like 865. It's just there's the base form, and then there's a lot of different schedules and a lot of different forms you have to include. And so, for example, 5471 is not just that form itself, but it's also then all the schedules E through R, which are based on what your filing category is. Then there's also the GILTI forms based again on what your filing category is, etc. That's the preparation part, right? So that already is expensive on its own. But obviously, what's the taxation? Are you going to be double taxed? Maybe it can happen. It can happen. So best case is you do not have a controlled foreign corporation. So your company that you have is not 50% or more. It's not over 50% owned by US citizens, right? You may have control over it because, say, you have shares and then your non-US citizen spouse has shares. But if it's not majority owned by US citizens directly, it's a non-controlled foreign corporation. So while you do have to declare it on Form 5471, there is no taxation of the net profit. The IRS cannot touch that net profit. They can definitely tax the salary you take out and the dividends you take out to yourself, but they cannot tax the net profit. If you have a controlled foreign corporation, so you own, not even you, but US citizens own over 50%, right? So this is most common with someone that just owns 100% of the shares in a company. Then if you pay over 18.9% corporate tax, this tax rate can change at any time. It's just based on the current US corporate tax rate that's standing. But generally right now, if you pay over 18.9% corporate tax rate, what we can normally do is use the GILTI high tax exclusion, meaning that there is no tax at all on your net profit. So again, only salary and dividends is taxable paid out to you. The worst case is if you have a controlled foreign corporation, your net profit is subject to taxation by the IRS. Like I said, if you pay over 18.9% of corporate tax, we can use a high tax exclusion. If you pay under that amount, we cannot use a high tax exclusion. What that means is your net profit, so income that has not been distributed to as salary or dividends, but the net profit of your company per year, no ability to carry over losses or take deductions from losses of prior years. This net profit is taxed at ordinary income tax rates on your tax return with no ability to use your personal foreign tax credit. You might be able to use corporate foreign tax credits. That gets a lot more complex, but generally the worst case is you will see your net profit transferred as other income on your US tax return and taxed at full ordinary income tax rates. So if you're in a country, if your company is incorporated in a country with very low corporate tax rates, Estonia, I'm looking at you, Romania, this gets tricky. You will need to do proper planning. Hong Kong too, also. Because if you pull out salary, you can use foreign earned income exclusion, foreign tax credit on your salary. If you pull out dividends, you can use personal foreign tax credits on that. If you leave all of that money in your company and you have a high net profit of 100K, the IRS will try to tax that 400K at ordinary income tax rates, and you cannot use the foreign earned income exclusion on it. So this is where it gets a little bit tricky, okay? I'm not here to scare you. I'm just here to tell you what is, as the slide says, the true cost of a foreign corporation on your US tax return, right, obviously. And again, like I have repeated myself already, there is obviously that giant late filing fee, but hopefully you never get there, so we don't have to talk about it too much. Like I said, right, you don't want to be in a situation where your net profit is fully taxed at, as GILTI on your tax return at ordinary income tax rates. Here's some tips you see on the screen. Again, it's a little hard to delve into this, and if you're in the situation, we have a planning service where you can walk through it. You can just, do your foreign corporation tax reporting with us, and we will walk you through it at that point as well. But obviously, if you're doing it for the past year, you're a little late, so maybe planning is better. Remember, foreign earned income exclusion, foreign tax credit, personal foreign tax credit, cannot be used on GILTI. But salaries, salaries that are paid out can use the foreign earned income exclusion. So this is pretty useful for those living or having companies in low corporate tax rate countries. Okay, you get what I mean. Dividends, also an option. And like I said, there's a GILTI high tax exclusion. And if really needed, we can use a Section 962 election, which is eligible for those that pay lower than 18.9% corporate tax rate, meaning we use your corporate taxes to then try to offset the GILTI. It will always still result in some tax. And it's not useful for everyone, but it is obviously useful for those that are like, having 100K net profit with maybe 11% corporate tax. So we can at least offset some of the US tax. So that was a lot of information. Maybe not relevant for everyone, but hopefully if that was relevant for you, or maybe if you were just self-employed and you're thinking about making a corporation, maybe you're thinking a little bit more about it versus just, starting these, open a corporation for £1 online, blah, blah, blah. Okay, let's go over the profiles, right? So let's summarize. What are the common self-employment profiles? Again, I don't talk too much on partnerships here, just because that is more rare, but keep in mind that, if you have a foreign partnership, you're also on the hook for foreign corporate forms. Not always, but you can be, depending on how much you own of that partnership or your interest. Okay, if you're a digital nomad, right? You just hopped on a plane, hopped on a train, whatever. And you are now a freelancer, you're working for different companies, etc. You're getting 1099 non-employee compensation forms from the US because you're working for US firms that don't care where you're located. You're not paying any local taxes where you are because you're just hopping from country to country. You're not registered anywhere. You're just living life. You're probably going to use foreign earned income exclusion on your self-employment income, but you should expect to pay self-employment tax. You can't use foreign earned income exclusion on self-employment tax. Totally possible for a freelancer to make 20K of income way under, the foreign earned income threshold, but then still have to pay tax to the US because of self-employment tax. Self-employment tax is 15.3% about on your net profit above $400. So if you earn over $400 in net self-employment profit and you can't claim a totalization treaty, expect to pay 15.3% of the excess of that in self-employment taxes. Now, you're a self-employed person abroad. You live somewhere, you're registered there, you are a freelancer, sole proprietor. Pretty easy normally, actually, because you are filing Schedule C. Just like the digital nomad, it's freelancing income. You can claim foreign earned income exclusion, foreign tax credit because you're paying local taxes abroad. If you have a totalization treaty available to you, then there's no US taxes normally due, right? Because you're not paying income tax, you're not paying self-employment tax. If you're a business owner, right, you have a corporation, you have a partnership, you have a business owner, you have a corporation, you are going to be reporting your salary or dividend, right, as it is. So salary is compensation, dividend is dividend. I don't know how to make that more simplified. But you will also then have to file Form 5471, possibly, right, depending on your shareholding. There are cases where you own, between 10% to 50%, and you're not related to anyone else that is owning shares in the company, and no other shareholders are U.S. citizens, and there's no shareholding changes. In these cases, there is no 5471 needed at all, only in the year of shareholding changes. So if you need to file for Form 5471, you do that when you need to, and then any salary or dividend you pay out to yourself, you can use foreign earned income exclusion on the salary, you can use foreign tax credit on the salary or the dividend. Obviously, if you have a controlled foreign corporation, you might be subject to GILTI taxation, as I have talked about extensively in the last few slides, but there's no self-employment tax. Yay? And then if you have a partnership, it's not on the slide, but if you have a foreign partnership, normally that income would then flow to Schedule E, and you can use the foreign earned income exclusion, you can use foreign tax credit, and it would be seen as possibly, self-employment income that's subject to self-employment tax. You could also claim a totalization treaty. Again, it's just not that common, but if you're in that bucket, be aware that there are different things that you have to consider there as well. A lot of information. Yes, you probably can tell I'm also a little burnt out from all of that. Alrighty, so that's a wrap on the business talk. I just go quickly over, basic tax 101s just in case you have questions, because people always have questions and always need a few reminders. Why are you even here? Because you are a US citizen or you have a US green card. And even keep in mind, if you have a US green card and you left the US and you're like, oh, my US green card expired. But if you didn't formally give it up via form I-407, still on the hook. So basically, if that's you, your worldwide income, right? So all worldwide income, not just US, but all worldwide income, before deductions, before taxes, your gross worldwide income, if it's over the filing threshold you see on the screen, this is, obviously for the current tax returns that's being prepared now. It changes every single year. If you're over that for your filing threshold, you got to file a US tax return. That's why you're here. Sorry. And then just if I told you all this information and you are freaking out, because you have a foreign corporation or whatever, and you have not been filing your taxes either at all, or you haven't been including the right forms, don't worry. There's always a solution to all problems. The solution that you're looking at is the streamlining solution. So streamlining foreign offshore procedure is an amnesty program created by the IRS that if you haven't either been filing at all, or if you've been filing, but you have forgotten to add, foreign corporate forms or other high penalty forms, you can amend your last tax returns as well. So it's not just for people that haven't filed at all. But basically, you only have to do 3 back years. There is an exception. There's always an exception. I just have to say it before people get mad at me. If you have a foreign corporation that was incorporated prior to 2018, and you had positive retained earnings as of December 31st, 2017, and that company is more than 50% owned by US citizens, so it's a controlled foreign corporation, you may have to streamline all the way back to 2017 because of the one-time transition tax. That's the exception. So let's ignore that. If you don't fall in that bucket, you only have to do 3 back years. So that is currently, while I'm filming this, back to 2020. And then obviously your current year tax return, right? You don't want to miss that one as well. Then you only have to do 6 back years of FBARs, and maybe you even get a refund. I mean, at the point you see this, it will be too late for your 2020 refund. That is out the window as of June 15th, 2024. But you can still get the stimulus refund from 2021, right? There was still around 3 in there. If you have children that have US Social Security numbers, you live in a high income tax country, they're under 17, you might even get the refundable child tax credit. So, it's not all bad, but basically you can streamline. We support streamlining. You can do that with us. We support streamlining with foreign corporate forms. Whether you're simple, whether you're super complex, right, depending on your business structure, we can help you. And yeah, I don't know. I hope you found this informational, helpful. Here are some filing deadlines to just be aware of. Obviously, most of them have passed already. And when you're watching this, then I think only the October and December one will be there. As December's not on the screen, but another helpful hint for those with foreign corporations, because it can take a little while to get your local financial statements, which we do need to file these forms, would be that by the October 15th deadline, assuming you have an extension to October 15th, you can send in not handwritten, but you can send in a printed letter with a handwritten signature to the IRS requesting an additional extension till December 15th. So that's also useful because, again, late 50 Form 71s can have a $10,000 late filing fee. We don't want that. That's it. That's a lot of information. There's a Q&A right after this. If you don't get your questions answered, if you don't want to ask them now, if you don't have the questions now because I've just overwhelmed you and you need a little processing time, go to MyExpatTaxes.com. We have a live chat. You can send us an email at team@myexpattaxes.com. You can find us on Facebook. All the links will be provided. basically, we're here for you. I needed a tax software when I first moved abroad, and so I created one, and I just realized how much everyone else needed that. And so every single year we continue to improve, we continue to take your feedback, and like I said, if you're simple, you can use us. If you're complex, you can use us. If you don't want to talk to anyone, you can use us. If you want to talk to someone a lot, you can use us. Happy filing. Thanks for tuning in. The filing deadline for those with a filing extension is October 15th this year. Remember, the FBAR has the same exact filing deadline, which is October 15th. So if you are a new client to MyExpatTaxes, make sure to take advantage of our promotion code here on the screen so that you can get 10% off the base price.